we're paying taxes at levels that are efficient, and ultimately over the entire life cycle of our enterprise or what we're trying to accomplish, we are as efficient as possible. Personally, I have a niche market where I work with syndicators. So it's similar to you, Sarah. Exactly. I've got probably managed somewhere in the ballpark of 350 to 400 syndicated tax returns at this point. But really love the ability to work with syndicators from inception to completion. So, be instrumental in what they're doing, work with them on structuring, on business plans, on things of that nature. Really, again, going towards just being as efficient as possible and being as proactive as possible. Outside of that, I'm a cyclist, I'm a snowboarder. I like the outdoors.
And you like oysters. We went to oysters and you came to visit.
I do enjoy oysters.
Awesome. Cool. Well, thank you for that intro. All right. You ready to jump in, everyone? I'm excited. All right. So, Tim, I'd like each of us to talk about, well, you're the expert, so basically you, and I'll give my input on the top 3 ways that, when you meet someone and you're going to be a client, they're going to be a client of yours, like the top 3 things that you're like, hey, are you doing this, this, and that? Like the top 3 suggestions to make sure that it's like, hey, this is easy. Almost anyone could do this. I focus in one area, but what are the kind of the top 3 things you immediately suggest?
I mean, ultimately, it's different for every person. So it just really depends. When someone comes to ProVision, we look at where you've been and where you are today. And so ultimately we look at what you've been doing to see, hey, what is it that you've been doing? What have you been utilizing the tax law? Where are you today from a structuring standpoint? So one of the easiest things is, are you using the right entities? Are you taxed as the right taxable entity? Looking at, those type of things, look at low-hanging fruit, look at, if you operate a business, are you taking all the deductions that are available to you from a business standpoint? If you have a family, are you employing your children? Are you employing your children as employees? Are you utilizing Roth IRAs to get money into retirement plans for them at a young age? Really just kind of looking at all of that. And then making sure today we're as efficient as possible and making the moves that we can. And then from that point, it's really moving forward. It's what do you want to do? Because that's the most important for me. I can tell you what to do, but if you're not comfortable doing that, it's not going to make any sense. So it's really just looking at, what do you enjoy? Do you enjoy real estate? Okay, well, what is your involvement in real estate? Do you want to be an LP investor? Do you want to be a flipper? Do you want to be a developer? What does that look like? And let's make sure that we've got all the deductions and things in line in that regard. Are you a W-2 employee? And as such, you are, essentially the fuel, that machine, that fuels the machine that is the US government. And if that's the case, then what can we do in that regard? And what advantageous investments are there? Is it oil and gas? Do you have a spouse that we could potentially bring into the fold and do something from a business standpoint to give you deductions that offset your W-2? So I know it's a horrible answer to your question. But ultimately, if I am looking at a client and they're a client of ProVision or came to ProVision, chances are they're not stock market investors. They're not traditional investors. They're looking at alternative investments. So, really real estate in any way, shape, or form, oil and gas, and then various other alternative investments that might give some tax benefits. Today, it's the Inflation Reduction Act and the energy efficient credits that came out of that has become a huge item of discussion.
Yeah, I love it. So if you guys just kind of in summary, Tim, the top 3 ways: entity structure, what deductions are you taking with your family, etc., and investments. Mm-hmm. And so entity structure is kind of over my head. I rely on other people for that. Investments, that's my space. So then, okay, so there's the top 3 investments, and then the top 3 investments. Well, I know of 2. So you said real estate, and we'll go into how that can work for people. And then oil and gas. And then is there a 3rd alternate investment category that's getting really great tax deductions right now?
Anything carbon related, so carbon capture has become a huge thing. The Inflation Reduction Act that was passed in August was 100% focused on clean energy. So there's a lot of opportunity there. There's a lot more open in that regard, because prior to the IRA, our credits were being limited and they were declining. And on top of that, we couldn't transfer the credits. The IRA allowed us to ultimately sell our credits. So now it's a whole new opportunity where, hey, we can invest in something and maybe we can't use the credits. We can sell them to someone else that can. So that's created a huge new sector of opportunity for people to be able to utilize this as kind of a income arbitrage. If I'm in a low tax bracket or I can't use that credit, sell it to someone that's in a high tax bracket, and we both win.
Can you do that as well with the oil and gas, the benefits you get from that? Okay.
No.
All right. Okay, so that's really interesting. That's one that I didn't know about and I haven't explored. So that's really cool. Let's talk about oil and gas. So, a lot of oil and gas investments say, hey, you get 75 to 100% tax deduction in year one. And so people go, oh, that sounds great. Can you kind of give us the background of why there's a tax advantage to oil and gas, and then let's go into how people can use it?
Big business. That's how. Ultimately, it was lobbyists. So in 1986, the tax law introduced Code Section 469, which is passive activity loss rules. Said any activity that you're passive in can only offset passive income. So what they're trying to get away from is, prior to 1986, you invested in a multifamily and you had $1 million loss in it, you could offset your W-2 income. You didn't even have to be active in it because there was no distinction between the two. So in 86, they created this passive activity loss rules. And as part of that tax code, they created a carve out for oil and gas. Lobbyists did a really good job of being able to create this position. And what it ultimately ended up doing was it gave this carve out that said, if it's an oil and gas working interest and you invest in a way that does not limit your liability, you can take the losses from those investments against ordinary income. And in most cases, what you're seeing is, when they say 75 to 80%, these are traditional vertical wells or fracking wells where they're doing intangible drilling costs. So ultimately have an opportunity to write off the cost of drilling prior to that drilling started. So that's what you're seeing. And that can offset ordinary income up to an extent.
And what is that extent?
The 2017 Tax Act created something called excess business loss rules. And so that caps the amount of deduction from flow through businesses that can offset W-2 income, pension distributions or IRA distributions, and any portfolio income, so capital gains from equities, things of that nature. It started at $500,000. It has grown. It will continue to grow at an index for inflation. So I think it's about $580,000 this year if you're a married couple, and half of that if you're single.
Okay. All right. Excellent. So let's review again, because this is the question I get a lot is, wait, so what can it offset? Just my W-2 income? And you're saying it can be W-2 income. It can be distributions from a retirement account.
Yep.
Yep.
Interest, dividends, capital gains, any of that, up to 568 or 580, depending on what year you're looking at.
Okay. And in addition, the income that you would get from that oil and gas investment.
Yes. So it's considered flow through. So there's different sectors. Flow through income is anything that if you have a Schedule C and a sole practitioner business, you've got a rental property in your personal return, you've got a partnership, an S corporation. Those are all defined as pass-through businesses. And so the losses from oil and gas can offset pass-through income indefinitely. So if you've got a business that has $1 million of profit, you could have $1 million loss from oil and gas, and they would offset each other. It's just when you get outside of that, what they call pass-through sector, and you get into the W-2s, the IRAs, the portfolio income, that's what's capped. So one of the structures that we utilize a lot with this is looking at Roth conversions. Someone's got, $500,000 in a traditional IRA. Well, let's get it converted to Roth now if we can, and use the oil and gas investment up to, $500,000 to offset that. So now we've got a Roth that is now tax-free forever, and we've paid no tax on that conversion.
Yeah, there you go. Awesome. On this note, David is asking, if you make more than the 580K as a W-2, can you take more than that of it as a deduction?
No.
I think the answer is no.
No.
So, sorry, David. I wish yes. Is there anything you can do with entity structures to help with that piece of it?
No. I mean, if any business that you have is going to be designed or is ultimately going to be considered a flow through entity. So you're going to be in a good position in that regard if it's an S corporation or partnership. What it really comes down to is looking at the calculation, looking at salary you're paying yourself if you are the business owner.
Yes, it's just turbulent.
Yeah, keep going.
So ultimately, it gets to looking at what can we do to minimize salary, reasonable salary. We've also got another little caveat that came out of 2017. It's called the qualified business income deduction that is based on the salary that you pay out of the business. So it's all these working pieces that come together. But if I have a lot of clients. I have a client that works at Google, makes $1 million W-2, and wife. Prior to 2017, we could, knock out all of their tax liability with real estate. After 2017, now we're limited to, it was $500,000 after that. So,
yeah. Then I see another question on that. If you invest in oil and gas, since you're talking about the Roth conversions, if you invest in oil and gas and it's not leveraged and you use your IRA or solo K to invest in it, will you be subject to UBIT? And the one that I'm currently in, they suggested don't use your IRA or your 401k in order to invest in oil and gas. You're shaking your head. Why don't you elaborate on that?
I mean, you can if you want to, but so UBIT is just unrelated business income tax, or, a lot of times people say UBTI, which is unrelated business taxable income. And what that is that taxable income is anything that's not related to the purpose of that exempt organization. So this falls in for charities, for retirement accounts, whatever it might be. But the definition of a retirement account is an investment vehicle. And so if you are investing in things that would be considered investments, so stocks, bonds, equities, things of that nature, it's not subject to unrelated business taxable income. If you invest in a business through your IRA, all of the income that comes out of that is considered to be taxable income, taxed at the highest tax rate. Oil and gas falls under that. So if you do invest in oil and gas in an IRA, you just have to be aware that any of that income that comes back to you in the IRA is going to be taxed at, once it gets above $12,500, it's 37%.
Okay, cool. That's good to know. Yeah. So I guess that's why it's suggested not to do that. But Todd, I think you're the one that asked the question. So Tim was really saying, use it not as an investment of the IRA, but as a rolling into a Roth. You would be taxed at that time. And so use an oil and gas investment in order to offset the tax of that conversion. Okay. All right, cool. Awesome. Okay. So I'm trying to make sure we're answering all the questions in the chat. There's quite a few. Feel free to grab any that you see that are relevant to what you were just saying, Tim. You might have gotten most of them. Oh, here's a good one from Jim. If you file jointly with a spouse, will this investment deduct their AGI as well?
Yes. So ultimately, since you are filing jointly, all of your income comes together. So if one spouse has a W-2 of $500,000 and the other one has a loss from oil and gas of $500,000, they'll marry together and ultimately offset each other.
Perfect. So if there's a Mark and Jane, and Mark makes no money and he invests in the oil and gas in his name, Jane makes 500. It doesn't matter that Jane makes the money and the investment's in Mark's name.
Nope, not at all.
That's great, because a lot of people ask me that and they're like, oh no, I signed the paperwork in my name. It needs to be in my spouse's name. Doesn't matter as long as you're filing jointly with your taxes.
Correct.
All right, great to know. Cool. This is a sad one. This is from Steve. Steve, I think this is very sad when I hear this. Someone who exited a business and they already paid the capital gains. If you are on here and you're going to sell a business or you're going to sell a property and you're going to have like over $1 million in profit coming to you, please get in touch with me. Tim probably knows this as well, but we have a team member we work with so that you can exit and not pay the capital gains and then redeploy that into investments that you prefer. So it's not a 1031 exchange, it's another vehicle. But it makes me so sad when people are like, oh, I sold my business, I made 200, but I paid for it. I made 2 million, but I paid, $500,000 in tax, depending on where you live. And now I'm left with so much less to invest. Instead, there's vehicles you can go into and you don't have to pay the capital gains tax, and then you can choose investments to go into. But if you already paid the capital gains, and I'm assuming it was last year, then in 2022, Tim, is there anything they can do in 2023?
Depends on when the sale was. I mean, you could get into a qualified opportunity fund and defer that gain. Now, that horizon is becoming less and less because you've got to recognize that gain in 2026. But ultimately, the stipulation is you've got to reinvest that capital gain within 6 months of the recognition of that capital gain. So if your business sold November 30th, you've got until, I think, April 30th of this year to invest in it. Sorry, May 31st. But ultimately, that's an opportunity. But in most cases, once it's done, there's, from a reactive standpoint, that's really the only opportunity you have. But if you sold something January of this year, you've got 12 months to plan for it. So it's a huge opportunity to be able to utilize that and at least offset what you can through reinvestment, through, other deductions and things of that nature.
Yeah, awesome. All right. Another question. Can you invest in working interest through an LLC and still claim the intangible drilling cost as a deduction on your personal taxes?
You can. It will be passive. So it will not be active. It will not offset active income, so W-2 income. One of the requirements in order to get that carve out is you have to invest through an entity that does not limit your liability in any way, shape, or form. And it specifically calls out LLCs in the tax code as something that limits liability at the state level, because that's what an LLC does, is it limits liability through the statute of the state that it was organized in. So it has to be in your personal name or in a revocable living trust, or through another general partnership that doesn't limit your liability.
Yeah, that's really important to know because and maybe we should back up and talk about it, the difference between ordinary income and passive income and those two buckets. Because if there are folks on here and they are real estate investors and they don't have W-2, they don't have a large ordinary income bucket, if their passive income bucket is where they get most of their income and they wanted to use an oil and gas investment to offset this bucket of income, you're saying they should then use an LLC. Does it have to be the same LLC that they hold their real estate in order to invest?
No, it can be anything, but ultimately, yeah, I mean, that's the holy grail. I've got all this passive income that I need to offset because it's very easy to do. And you don't have to kind of adhere to these, to these boxes to make it work. So in that circumstance, they can invest in oil and gas and anything that they want because whether it's active or passive, it's always going to offset that passive income.
I hope that helps, Kevin. Now, this one is important. It's not really about the structure and the tax advantage, Tim, but you see the results of the investment. So I have a question. There's a question like, hey, but what about the oil and gas investments going south? Like, what are the chances that it's going to be a bad investment? So I invest 100K, I get my tax deduction, but then I don't really get good returns on my investment. You've been seeing this for a long time. So have there been ebbs and flows? And have you seen that this is a good time people have been getting the expected or strong returns on those oil and gas investments?
Yeah, I mean, I think there's a lot of things no different than a syndicator that go into it, than in a multifamily. You've got to look at the operator and the operator themselves and what they're doing, how they're mitigating risks. I've had a lot of clients in the last, 5, 7, 10 years that have done things for high risk, high reward, and ultimately, they invested in one well that came up dry. Well, they lost their entire investment, or they invested in 3 wells and 2 of them came up dry. And so they only, really have one well that's producing. So really looking at what the investment is, looking at what the, for lack of a better term, pipeline of revenue is, and then how are they mitigating and how are they as an operator? I've been doing this and looking at oil and gas investments for 15 years now, and some are great, some are bad. Unfortunately, it does matter because a lot of it is based on the price of oil or price of gas. So you've got to look at what the trend is and look at things like break even. Look at what the break even dollar amount is and see, is that attainable? What's the track record? What does it look like? But ultimately, I can't give you an answer of it's been great, it's been horrible. The last 12 months has been, in LNG has been fantastic. But it shot up to 8 or 9 and now it's back down to 2.5. So it just depends on what the market is and what the market brings.
And I think that's a perfect answer, because a lot of people, in our offerings, they bring it to their CPA or their attorney to review the investments. And some people are like, yeah, you should do this. We've seen some really strong returns with our other clients, and other people say, don't do this. We've seen a lot of really bad things. And, when you ask a little bit further, it's kind of like what you said, is the investment diversified and what's the track record? So it's similar to real estate where, you have to look at the track record of the operator in any passive investment. So what have they done over the last couple of years, given what's going on in the economy, and what have they done before that as far as the returns for investors? And then also the second thing is diversifying. So like you said, if it's one well and it comes up dry, you're at risk if you're investing in one thing. And so I see that being very similar to real estate. If you invest in one single family home as a rental and, it turns out bad for some reason, the market's not what you thought it was, or you get a non-paying tenant in there, that you're riskier if you have one single family home investment versus if you're in, you have a 400 unit apartment complex, you might have some bad tenants, yada, yada, you're diversified so it can lower your risk. So I can kind of compare that in oil and gas. If you're in some sort of fund and the fund is diversified across maybe 20, maybe 200 different sites and it's a large fund, then that risk of oil and gas coming up dry would be theoretically reduced if it's in a fund model.
Exactly. Yeah. Everything's about diversification and not specifically everyone talks about diversification, mitigation of risk. And, in the traditional term, the financial, analyst will tell you diversify across all these sectors where, if you love real estate, focus on real estate and diversify by utilizing, scale. Same in oil and gas. If you want to invest in oil and gas and you think it's a good idea, look at scale. Don't look, unless you're a risk taker and you want to take the risk of losing everything you have, diversification in that regard is good.
You want to risk everything you have.
I've seen it. Unfortunately, I've seen people with millions of dollars into wells that have come up dry, and it's hard. But there's a lot of operators out there that are looking more inward than outward and looking at what they're going to benefit from and not what the investors are. So
I hear that. Yeah, that's part of the due diligence on the operators, right?
Yep.
Okay, so we're going to spend a little bit more time on the energy because I see there's 20 other questions I haven't gotten to. So this is from Stuart. If you have mineral rights income from Oklahoma but live in North Carolina, can you file for a refund of the taxes that Oklahoma withholds from the mineral rights income? Pretty detailed.
I mean, technically, yes. So states have treaties, for lack of a better term, treaties with each other where you don't get double taxed on the same income. So typically you'll get taxed in the highest jurisdiction. So if you live in California and you have income in, in Arizona, that's at 2.5%, you're always going to pay California income tax, and California is going to give you a credit for the supposed tax that you would have paid to Arizona. So same thing with North Carolina, Oklahoma. It's going to be one state's going to give you a credit for the taxes you paid in the other state. And it really just comes down to the highest tax jurisdiction is what you're going to pay tax on.
Got it. Question about the pension, 1099 pension income. Is that considered ordinary income that can be offset by the oil and gas?
Yes.
Cool. That's from Terry. Are there other passive investments that offer significant deductions against ordinary income? So Tim talked about oil and gas, the carbon capture from the IRA last August, you said. Is there anything else?
Not really, unfortunately. Okay. And ordinary income, 2017 Tax Act really got rid of any deductions that you could take against ordinary income. Got rid of unreimbursed employee expenses, got rid of investment expenses, minimized the amount of state tax or taxes that you could deduct against ordinary income, limited mortgage interest. So unfortunately, it really limited the amount of deductibility. And so you've got to look at investments like oil and gas, and then, other investments that generate credits like solar, putting solar on your house and things of that nature.
I see a couple more questions about the conversion to Roth and how to use that. Can you explain that process again?
So it's utilizing outside money to convert inside money. So if you've got, $500,000, let's say you've got I've got a client that we utilize this strategy for I think the last 5 years. But ultimately what we looked at was where he was in his tax rates and what he had in his traditional IRAs to convert. So every year he was looking at, I've got X and I've got Y coming in from outside investments. If I reinvest Y in oil and gas, how much will I be able to offset? And what will that look like from a tax rate standpoint? And so we kind of modeled it to make sure that we were taking advantage of all the standard deductions or itemized deductions, taking advantage of the 10% tax credit or 10% tax rate, the 12% tax rate, and then really cap him at about the 22%. So that ultimately he was paying very low tax on the conversion and he was offsetting all the additional. So it really is just a function of, I've got $500,000 in my IRA I want to convert to a Roth, so I don't have to worry about paying tax on that in the future. How much money do I have outside to be able to utilize to offset that?
Thank you. I hope that helped, Todd. Brian is asking, same treatment if you invest as joint owners with spouse as opposed to investing individually? I believe the answer is yes. If you file jointly?
If you file jointly, yeah.
Okay. Now, if you file separately, but you invest in the investment jointly, then does it just split 50-50, the tax advantage between the two?
Depends on the state.
Oh.
If you're in a community property state like California or Arizona, you are, hypothetically speaking, in a community property state like Arizona or California, or pretty much all on the west side of the United States and Florida, you are supposed to split income 50-50, even if you file separately. In non-community property states, equitable distribution states, you can ultimately, if you file separately, technically the money, the income that is sourced to you is picked up on your return, and the income that is sourced to your spouse is picked up on their return. So you don't split those. Now, if you were to file jointly or invest jointly and file a separate tax return, you'd probably have to figure out a way to get 2K1s. because K1s are sourced to social security numbers, and you can't have two social security numbers on one K1.
Oh, got it. Right. Okay. I hope that helps, Brian. This is back to Steve, who was talking about his business that he sold. He says he has not paid the taxes yet, but he sold the business in September. Do you think it's worth him reaching out to you to have a direct conversation? Is there anything to be done?
Yeah, I mean, ultimately, his goal now would be to see if see if it made sense to even invest in a qualified opportunity fund, and if that was an opportunity. He used the word twice, but an opportunity for him, then ultimately it would be something that he would really have to. I mean, if it was in September, he's got a month to invest. So it might be a little too late for him, just simply to do due diligence and make sure he's making a sound investment.
But I guess, Steve, if you have already done due diligence on some options, then I think which I think he has, I'll say, because we've been talking. So you might still have time. So I'd say, yeah, get in touch and see what you can do, Steve. Lynn, passive loss deductions can cover the taxes due for a traditional IRA to a Roth IRA conversion, correct? That's what we were talking about? No, that's not correct.
No.
Oh, not passive, the oil and gas loss deduction.
Yes.
So not real estate loss deductions, but the oil and gas loss deductions can cover the taxes due for an IRA to Roth IRA conversion.
Correct.
Cool. Terry's asking, what's the number where it makes sense to contact you for lowering the capital gains from the sale of business or piece of real estate? So for business, Terry, $1 million or more. For real estate, it's anything. So we can, if you sell a piece of real estate and you have $100,000 or you have $2 million, we set up our syndications so that you can 1031 exchange into them. It's called a 1031E. And so, the only thing is the timing of it, making sure we have something open. But if you're selling, so that's for anyone on here. If you're selling real estate and you want to 1031 exchange to not pay capital gains, but you want to go into a passive real estate investment. So you want to stay in real estate, you don't want to pay the capital gains, and you want to use that to go into a syndication, reach out to me, because we can, if you have $100,000 or more to invest, you can do a 1031E and you can join one of our investments. So I hope that helps, Terry. And then for business, that's not directly me, but it's someone I know, so $1 million or more. And then you can use it. You can sell your business, not pay capital gains tax, and then you can invest in syndications and oil and gas. You can basically split it up however you want. All right, here's something that's totally new to me. Can we defer taxes on RSUs, sell the RSUs and invest in oil and gas, and take deductions from this against taxes owed for the RSUs?
I don't know. I would have to look at that's a pretty long string of events. So I would have to look at it and look at how it was treated and what it looked like through the entire process. But probably, I don't have an answer. Sorry.
Okay, cool. So I see some more questions about, hey, how do you 1031 exchange? So if you have over 100,000 of real estate that you're selling and you want to 1031 exchange it, reach out to me and I'll talk you through that process directly, because it's not really the focus today. Question from Richard, which I got this one a lot, Tim. If I'm selling a rental that will create a large capital gain tax, can the oil and gas investment offset the capital gains and reduce taxes?
Yes. So if you invest in oil and gas through as a general partner, so without limit of liability, it will be an ordinary loss, and the ordinary loss will offset any income that you have. Now again, you have limitations for W-2 income, IRA distributions, and traditional portfolio income. So you sell a share of stock and you get a capital gains, the limitations there. But if you are selling a rental property that is considered a flow through business, so it's on your, Schedule E on your personal return, The capital gains from that is considered flow through, and as such can be offset by those losses indefinitely.
Very cool. All right, so the list of attendees is so long I can't see, but Troy or Kim, if you are in here, because they're asking me that, I'm selling a property. Should I 1031 exchange into an apartment building with you or invest in this? And so you're basically saying either can work. It depends on the preference.
Mhm.
Yeah.
Yeah. I mean, things are, the market has shifted. If you talked to me a year ago, I would have said, if you love real estate, do real estate. There's no reason not to, because we can just offset that gain with the losses from bonus depreciation. 2023, we've seen a limitation. We're down to 80% bonus depreciation. Still, you're probably looking somewhere in the ballpark of about 82 to 83% after you get the other depreciation added on top. But like you had, stated earlier, that market has shifted and now debt has shifted. So now instead of using bridge financing, which everyone was using, everyone's going to long-term fixed rate debt with lower leverage. So now we've got two factors that are pushing down the amount of deductions that we have. So, if you're looking to offset 100% of your income, real estate might not do that anymore, dollar for dollar. So oil and gas might be a great investment to utilize for that purpose.
Awesome. Then there's some questions in here about recapture. And I also got a lot of questions like this around recapture. So a lot of people are familiar with when you take bonus depreciation, there's a recapture at the exit because you lower your basis. Is it similar with oil and gas? Is there a recapture?
I mean, ultimately, it depends on what you're getting into, but intangible drilling costs are just the costs that you're allowed to deduct up front. So they're not something that you're going to recapture, but you ultimately have no basis in that investment anymore. So every dollar that comes out of that investment is going to be income. So it's not technically recapture, but it ultimately is going to be recaptured simply because you have no basis in that asset anymore.
Okay.
Something to be aware of, and something that a lot of people don't talk about, just want to put that out there, is these working interests in oil and gas are 100% subject to self-employment tax. So in a situation where you invest in these, you get a loss, and that loss offsets self-employment income in the first year. But throughout the life of that investment, it is always going to be subject to self-employment tax. So you've got to be cognizant and aware of that. You are going to ultimately pay self-employment tax on that investment, which could be up to 15.3%.
Okay. All right. That's good to know. And so in real estate, when you have bonus depreciation loss, it goes into a bucket and you can use that until it's empty. It doesn't have to be in the year you receive it. I can use it next year. I can use it next year. I can use it 10 years from now. I can use it until that bucket is empty. Now, with the oil and gas, does it work the same way?
It does. So since it's ordinary, and if we're investing as to have it be ordinary income, we don't have any ordinary, income to offset, it just becomes a net operating loss. And net operating losses carry over indefinitely. So until you utilize it or you pass away.
So if I invest $500,000 with my spouse and we get that 100% write off, but we only make $200,000 this year, there's 300 that is kind of in the bank that we can use later.
Correct.
Cool. I hope that summarizes a lot of the questions that were here. I see a lot of questions that are asking for clarification still around the IRA to Roth. I would suggest go ahead and listen to the recording of this a couple times because Tim explained it twice. Just go ahead and listen to it so that we have time for other things. I guess this one specific thing from Mark, just making sure that conversion strategy that you stated, does it work in all states? Does it also work in California?
Yeah.
Okay.
Because that's federal. I mean, and California doesn't limit. California follows federal in that regard. But I can't speak specifics to all 50 states or, all the states that have tax, New Jersey, Pennsylvania, things like that. have kind of oddball rules, but in most states that follow, so a lot of states follow Fed. So they basically start with adjusted gross income at federal level, and then they do modifications, add backs and subtractions. Some states like California, they don't follow Fed. They have their own calculations. So they do follow oil and gas rules, but some states might not. So that's something you definitely want to reach out to your accountant or CPA and make sure before you're doing this.
I see a question from Lawrence. Where can people go to invest in oil and gas? So Lawrence, you can reach out to me. I'm not like presenting an investment on this webinar, but if you're interested, you can reach out to me and I can talk to you about that privately. All right, here's a good one. Are there any tax benefits in investing in multifamily syndication for an individual with ordinary income? Well, eventually, hopefully, you'll get income from your multifamily syndication. So the tax benefits from your multifamily investment can offset the income you're going to get from that multifamily investment. Correct me if I'm wrong, Tim, but it can't do anything for your ordinary income.
Correct.
All right, got it right.
I mean, yes. Let's just stop with yes.
And is there something really creative people can do?
No, I mean, if you have, so let's say you only have, let's put this in a bubble and say you have one, passive investment. You've got a rental property that you bought 100% and it's a dog and you lose your shorts on the sale. That in a year of sale, if that's the, only activity that you have and you didn't group it with other passive activities, that converts to ordinary income. So yes, if you sell something at a loss, it's passive activity, it will convert to ordinary loss and then ultimately be able to offset that. But I'm hoping that no one is doing that just for tax purposes, because you lost $1 to save 37 cents.
Yeah. No, there's better things you can do.
Correct.
Dan, hi Dan, good to see you in here. He's asking, can you use passive multifamily bonus depreciation to offset taxes due from a 401k Roth conversion?
Say that again.
Can you use basically you can use bonus depreciation from multifamily to offset taxes due from a 401k Roth conversion? No,
unless you're active in that. If you're a real estate professional, that would be the only way.
Okay, Dan, you may be a real estate professional. I can't remember. He may be. So if he is, then he could do that?
Correct. If he's a real estate professional, it converts rental real estate to active trader business.
Okay, there you go. A couple people asking about the recording. Yes, you can see there in the top left-hand corner, the recording button is on. It'll be shared with everyone. Okay. I see some questions specific to, if you're interested, you can reach out to me, but I'm not presenting a specific investment. There are a lot of people who did invest in an oil and gas investment with me already who have questions, which is why we originally wanted to have this. So, but if you're interested, you can reach out to me privately. All right, so this is going back to when we were talking about the top 3 ways in the beginning, Tim, and there was investments, entity structure, deductions. So it's questions about deductions. Can you discuss the ability to take deductions for things like books, home office costs, passive real estate syndication versus oil and gas investment?
Ultimately, if you've got a trader business and it's ordinary and necessary, you can take a deduction. So you've got to look at, again, going back to 2017 Tax Acts. Prior to that, we could deduct things like publications, investment expenses, things of that nature. We can no longer do that. So in order to get a deduction, it has to be a trader business. So it has to be something that you're in that is related to a business profit motive that you have. And if you do have that, then it's looking at, in the tax law, it's just has to be ordinary and necessary. And everyone says, well, what's ordinary and necessary? You've got to look at what sector you're in and what is ordinary and necessary. Myself having a jet and flying clients in to meet with me is not ordinary and necessary in the CPA world. But if I was a hedge fund manager in New York City and I was trying to win a huge account, that would be ordinary and necessary. So anything can be deductible. You just need to look at what is ordinary and necessary and how to make that ordinary and necessary.
Thank you, Tim. Another question is around funds. So talking about, if you invest in one syndication, you get a K1 for that. And it's like, okay, that one syndication in Texas. If you invest in a fund and it's a real estate fund, it's a syndication real estate fund, and there's some properties in Texas, some in North Carolina, some in Georgia, some in Indiana, you get one K1 from the fund, but then do you have to file taxes in all those states?
Yes.
Yes.
Typically it will, unless the fund itself files a composite return, which has some restrictions on it, you will get a K1. So ultimately the fund, if there's 5 different states that it has property in, will file in those 5 different states. So you will get one K1, but you'll get a K1 from North Carolina, from Georgia, from Tennessee, or well, not Tennessee, but from any state that has a potential tax liability in. And then you've got to look at individually whether or not you rise to the level of needing to file. So yeah, it gets a little cumbersome with funds, and especially if there are funds, I've seen funds that have 30 or 40 states. So it can be, yes.
That's quite a lot. Yeah. Because it's good to be diversified. That's why you're in a fund. But then if it's too diversified, then it does become cumbersome. Wondering if it's the same with an oil and gas fund investment. So, we were talking about it. If there's one drilling site, you're at risk if it comes up dry. If you're in a fund that has 200 drilling sites, maybe it's across 4 different states, then you'd have to file in those 4 different states.
Correct. So, and a lot of times those funds, they might be diversified, but they might be all in one state. So you might have some, that are in North Dakota, Texas, Pennsylvania, Mississippi, wherever it might be. But yes, if they're in all 4 of those states, except for Texas, that doesn't have a state tax, you might have to file in all of those states.
Got it. That's what I figured. All right, from Kristen, I'm selling. Well, let me check. We're at the top of the hour, Tim. We have a lot more questions. Are you able to stay on another half hour, or do you need to go?
No, I'm good.
Okay. All right. It's a large participation when it comes to taxes, always. All right. So this is Kristen selling a property in an LLC that is taxed as a partnership. Members are me and my husband. Since we're selling in the name of the LLC, do we have to purchase in the name of the LLC in order to avoid paying the capital gains? I'm summarizing. If they're using the oil and gas investment.
No.
Okay. There you go, Kristen. No. All right. I'm going to scroll through because some of these are redundant of what we already answered. All right. Is the self-employment tax still applicable for the oil and gas investments once the GP has been converted to an LP?
Yes, it's throughout the life. Actually, it's throughout the life of the investment, but actually in the tax law or tax code, it specifically says that a working interest in an oil and gas well is subject to self-employment tax, regardless of if you're active or passive in it. So.
Okay, cool. Scrolling through, looks like a lot of the same. Oh, here's a question around trusts. So I'm not very familiar with this, but I did have a lot of people ask me, is there, and this goes into, one of the top 3 ways to save on taxes using entities. Do trusts, is there any advantage to using trusts when you're making investments, whether it's oil and gas, real estate, anything?
Depends on your estate. I mean, It depends on what you're trying to do. Trust are outside of partnerships. Trust are kind of one of the most malleable structures that you can have in the tax law. So They're utilized not only for estate purposes, but, for income tax purposes. So it just depends.
Okay. All right. Question specifically for you, Tim, from Aaron. Do you personally invest in oil and gas and carbon capture deals?
I'm not answering that question.
All right.
He's one of my clients.
Oh, okay. Okay. You know, Aaron.
Yeah. So.
Okay. All right. You can ask him personally if you want, Aaron. Okay. I'm going to switch over to the Q&A now. I think I'll just hit on Dan's and then we'll switch over from chat over to the Q&A to answer questions. Dan is again asking, can I use, we answered this, Dan, yes. So can I use the multifamily bonus depreciation to offset boot from a 1031 multifamily sale that I actively managed?
Yeah, I mean, I think the answer, there could be specifics to it that don't allow it, but in most cases, I'd say yes.
All right. Do we get depletion allowance? Tim's shaking his head yes.
Yes, so that's one of the things with oil and gas. Not only, so you've got to look at it when you think about a multifamily in depreciation. Depreciation is just deducting the asset over its useful life. So you've got a multifamily building, its useful life in the IRS's eyes is 27 and a half years. You deduct it over 27 and a half years. It might be 50 years old, but ultimately you buy it, you get to deduct it over 27 and a half years because that's the way that the IRS sees, its useful life. Same with depletion. Depletion is just saying you're depleting the minerals in the ground. And so we're going to give you the opportunity to deduct the cost of those minerals over what we feel is its useful life. And the way that they do it is they say you get a 15% deduction against gross revenue on an annual basis. There's different calculations you can do. Some are really intensive, but the easy way to think about it is about a 15% cost depletion based on gross revenue on an annual basis.
All right. There's someone else asking, is the 580K limit per person or for a married couple that's married? So if you're single, it's half of that?
Correct.
Okay. Will my taxable income be calculated with gross income minus the investment in oil and gas 1-to-1 and my tax bracket set at the new income? Oh, so I think what they're saying is if I make $400,000 this year and I invest, okay, that's not a good example. How about I make $200,000 this year and I invest $150,000. So now my gross is 50K, which is a different tax bracket than if I make 200K. So now do I pay a lower percent tax?
Yes. The U.S. tax. So when they talk about marginal tax rates, that is the last, that if I tell you you're in the 37% tax bracket, that means that the last dollar that you earn is being taxed at 37%. But every other dollar prior to that could have been taxed at 0%, 10%, 12%, 24%, 30, all the way up to 37%. So one of the points and, one of the things that I do and look at is how efficient can we be? So if we're starting, in a situation, let's say we're making $500,000 a year, well, we're handily into the 37% tax bracket. Well, we've got the 37, all the way through the 30s down to the 24. You've got this huge jump from 24 to 32%. So a lot of times what I look at is, okay, well, what deductions can we take to get us down to the 24%, maybe the 22%, because effectively we're only paying tax at 17%. And so that's super efficient, especially if in the next year, we're going to be up at $500,000 again. I'd rather take a deduction at 37 cents than a deduction at 22 cents. So ultimately, that's kind of what you've got to look at when you're doing this and when you're planning is make sure that you are effectively using these deductions and efficiently using these deductions to pay the least amount of tax that you can using the tax law. Did
Got
that
it.
answer the question?
I think so. It answered it for me. All right, this is from Sheldon. What about investing in a working interest through a trust? I think we already answered that. All right, if you invest in oil and gas and you take 75,000 deduction the first year and the well comes up dry, the second year, can you take so assuming $100,000 investment. So if you lose everything, then in the second year, can you take the full $100,000 you paid for the investment off your second year taxes?
Yes.
We prefer that not to happen, though.
No.
We'd rather make money and pay taxes on it than lose money and pay no taxes. Personally.
Yes.
All right, Sachin, what is the strategy to avoid capital gains this year besides 1031 and opportunity zones? So we went through that, Sachin. We were talking about oil and gas and carbon capture. Those can both help you out there. Okay, so this is a little bit more complicated. This is from Benny. So it's going back to the Roth IRA conversion. So the oil and gas can cover our taxes for the conversion, but do we still pay the piper, he says, later on when the recapture happens?
I mean, ultimately, yes. I mean, you're going to pay the piper because you're deducting. Again, if it's oil and gas and you're taking a deduction, you've got to think of any investment that you do as, I like to think of it as a piggy bank. You put $100,000 into that piggy bank. If you get a distribution from that piggy bank, well, now your basis in that piggy bank is $80,000, let's say, because you got $20,000 back. If you got a $100,000 loss, that reduces the amount that's in that piggy bank. So now every dollar that goes back in is income to bring you back up. So ultimately, yes, you're going to recapture it, but time value of money, you're going to recapture it at a later day, be able to use the tax dollars to reinvest, and ultimately you've got inflation to think about. So yes, you're going to repay it, but if you repay it 5 years from now, it's going to be at a lower rate and a dollar with a lesser value.
Thank you for that. And then there's a question from Benny, and I think this would be great for everyone. As people have really specific number of questions, Tim, is this something that you can help people with? If they're like, okay, well, I want to do a conversion. So in order to do that, how much should I invest in? These are people who are already thinking of investing in my offering. And so they're wondering, like, what is the specific number? So if they want to work with a tax strategist to figure out the exact numbers that they should be using, what's the best way for them to get in contact with your company?
So two ways. And yes, definitely, this is something that we work through daily. This is kind of how we work with our clients to look at what we can do to mitigate taxes. But either go to our website at ProVisionWealth.com, and up in the right-hand corner, there's a contact us button, or you can send an email to contact@ProVisionWealth.com.
Putting that in the chat. And then also, you guys will have that information when we send out the replay, we will have that contact information as well. Right. And I think that's really great because there's the concept which you got today, but then how does it apply to you, and what exact numbers are you supposed to use, and what state do you live in, and what entities? Like, there's a bunch of strategies we talked about today. But before you execute them and go, oh, okay, so I should invest this number, I would suggest talking to a CPA if you have one. If you don't have one, I strongly suggest contacting ProVision. A lot of I don't even know how many investors we send over to ProVision, because they're adaptive as well. So it's not just like, oh, they know real estate. As you can see, they know oil and gas as well. They know the investment space. They know how to structure entities. They know how to look at what are your goals and how can we get you there. So I really, really strongly suggest going ahead and contacting them, contact@provisionwealth.com. And when we send out the replay, share the replay with someone you make your investment decisions with, whether that's your spouse, your child, your parent, your CPA. If you have questions, definitely reach out to ProVision. And if you have questions about investing, you can reach out to me. In the replay, you have my email because you're on this webinar, but I'll also send you an email with all my contact information.
Yeah, oh, go ahead. I was going to say it's extremely important. A lot of times you watch things and you look at things and it's one size fits all. And in tax law, it's not one size fits all. So you've got to be very careful and proactive in what you're doing and make sure that you're talking to someone that's educated and understandable or understands what you're trying to accomplish. Simply because doing things in a vacuum and thinking that you can, everyone talks about real estate was a huge boom. Everyone was talking about real estate and being a real estate professional. Well, that might not work for you. That might not be something that you can do. I will never be a real estate professional because I'm full-time, my full-time job is ProVision. So for me, real estate's a really great investment and something that I do invest heavily in, but I don't invest in it in a way to offset my ordinary income. I utilize other avenues or vehicles to offset my ordinary income. I invest in the real estate to ultimately offset other passive income and ultimately for the growth that it has.
Yeah, and like you said, that's the sweet spot, is getting to all the passive income. So if you always have active income and you never invest in things that give you passive income, then you're always trying to offset your active income tax. But ultimately, you want to get over to everything passive, offset your passive income tax with those, and that's, living the dream when that part happens.
Exactly. That's super simple. That makes my life so easy.
Yeah, there you go. I also put in the chat, everybody, a link to book a call with me. So I see Jacob, you're asking, is a recording of oil and gas deal that I did. There is. If you guys have any questions about investments and you want to talk to me about investing with Sugo Capital, you can click in the chat. It's sugocapital.com/book a call. If you have questions about taxes, don't ask me. ask Tim's team. That's who you reach out to. But if you have questions about investing, we have the investments that we've been talking about. So you can reach out sugocapital.com/book a call, and you will get me if you use that link. All right. All right. I think we hit everything. Looking at,
I was going to say I see one from Mercedes. I used to live in North Carolina, so I'm well versed in that state, but we also have, we have two managers that reside in North Carolina. So one of the nice things about ProVision, we're virtual. We do have an office, but ultimately we have staff throughout the country and clients throughout the country. So we file returns in every state and we're pretty well versed in all of them.
perfect. So that goes with Mark's question. He said, do you have expertise in California?
Unfortunately.
Seems like if you're in California, don't contact me. You're a pain.
I always joke about it because, I'm from there and live down the street from you. And so, ultimately I love California. I hate California when it comes to taxes and bureaucracy. So I'd move back there tomorrow if it wasn't for that.
Yeah. Yep. And I decided to stay, pay the taxes, and just make more money. Well, work with Tim to see how we can not pay so many taxes in the legal way, of course.
Yes.
Cool. All right. Well, this is a question from Jeff. Does ProVision write letters?
Accredited letters.
Accredited letters. If you're a client.
Correct.
Not a client, no. If you're not a client, you need your own CPA to do that, or use Verify Investor or something like that. But Tim signed one for me because I'm a client. This is a good one from Albert. So as it relates to setting up tax efficient structures, is it better to talk to a CPA or an attorney for the legal structure first?
From the legal perspective, always talk to an attorney. Always work with an attorney. Don't work with a doc prep or someone of that nature. But ultimately, what we do is we work with attorneys. So if you've got an attorney that you work with, we look at where you are today, what your structure looks like, what tweaks you might have, or what tweaks we think you might need. And then we sit down with the attorney. So, ultimately, if you're already working with an attorney, we sit down with the attorney and say, hey, this is what we're thinking. What do you think from a legal standpoint? Does this, pass muster? If you don't have an attorney, then we've got, some that we can recommend that we've worked with for years and years. But ultimately, the structure and the legal side of that structure needs to be vetted by an attorney.
There you go. Perfect. What about international matters? Actually, yeah, that's going to be in. I need to set up a call with you, Tim, because we started doing stuff out of the country. It was just like we did it, and then we're like, oh wait, we need to talk to Tim. But yeah, there's
depends. It depends. A lot of foreign investors investing in the United States, things of that nature, and one-offs, yes. But with 2017 and the new GILTI tax and what they did with all that, I stepped back from doing a lot of international, and as a firm, we did as well, because there's a expertise that's needed, and we just don't have the competency to do that.
Okay, so that's for people who are international investing in the US, and also for people who are in the US and investing internationally?
So if anyone's international investing in the US, we can work on the domestic side and work with their accountant, whatever it is, in the jurisdiction that we are. But I will not be able to advise, or we will not be able to advise on how X is going to be taxed in New Zealand,
totally,
so to speak. And then same thing. I mean, we can work with you on an investment that you make, how that investment in the US is going to be taxed or treated, if you're making an investment in Ireland. But you're still going to have to talk to someone in Ireland that has the expertise in Irish tax law to get advice on how to handle it there.
Great. And Tom said he is a ProVision client currently, and that ProVision is helping him with his foreign investments for the past few years, and it's been working very well. But he also has a country-specific guy. So
yep.
Thanks for that, Tom. All right, well, I'll say let's wrap it up. There is people asking me, those of you who are Sugo investors and you're asking about proof of accreditation, go ahead and shoot me what you have, and then we'll verify if that works. If you already have one from another investment, I don't know what parallel markets is, send them over. I'll take a look and we'll see if we can accept it. Okay, well, Tim, I'll say thank you. I always appreciate you being willing to help out our investors, especially as we're making these pivots and we have new things, and I, am less familiar with how the taxes work on those investments, even though I've done the due diligence on the investment. The tax side is always something I love to have you explain to people as a CPA, so I don't have to get in trouble for saying something wrong. Yeah. So I appreciate that. Thank you very much. Lots of people saying thanks. So everyone appreciates your time. It's a huge value add. And to everyone who came here, from Tim, I'm sure you're invested across the sectors and you're using the strategies that Tim's using. So I hope this is value add for you as well. We'll send out the recording, like I said, with both of our contact information on there if you want to continue to work with either one of us. All right. Thank you all. Thank you, Tim. Any last things you want to say, Tim?
No, I mean, really just make sure that you're being proactive in everything you do. It's extremely valuable. If you look forward and not look back, a lot of times people are always concerned about something else. But if you're not looking forward when you're looking at planning, whether it's investing or tax, you're going to find yourself in a position where you can't do much and you're going to end up having to pay tax. So
yeah, be proactive. Now's the time.
Yep.
Perfect. All right. Well, thank you, Tim, and we'll see you next time. Bye.